Welcome everybody to BDO's webinar focused on professional service firms. My name is Anna Jarrold and I am the tax partner leading our professional services tax team in the UK, which is 25 people strong. For those of you who do not already know, BDO is a global accounting network with over $7 billion in revenue, providing auditing, accounting and taxation services in 154 countries with over 64,000 people. And we've just been voted Global Accounting Firm of the Year at the British Accountancy Awards, which we're very pleased about. Today's webinar is to update you on how the base cost erosion and profit shifting provisions impact professional service firms, and it is an update on our previous BEPS webinar that we ran this time last year. Our two specialist speakers are Malcolm Joy and Duncan Nott, a tax partner and tax director, both based in our transfer pricing team, and with who I and others in my team work very closely with. You can ask questions during the webinar. Please use the Q&A feature, which is in the top right-hand corner of your screen, and please send questions to all of our panelists, and we will address as many of your questions as we can at the end of the webinar, or if time does not permit, after the webinar. We're also recording the webinar and we'll email you the slide deck as well as the recording in a couple of days' time, and we will finish within the hour. So how did we get to having to consider these provisions in the first place? Well, there's been an increase in view raised by governments and citizens and the press that some taxpayers were not paying their fair share of tax, and a moral debate has been had. And the view was held that the tax system was not fit for purpose. It shouldn't really be a moral question about how much tax should be paid. So the position moved very quickly from debate involving 90% of the global economy to the OECD recommendations in 2015, the guidelines, and then tax authority implementation in 2016 and beyond, fairly swift given the complexities of the whole position and the numbers of countries involved. The resulting 15 action points focused on establishing a coherence through the corporate international taxation systems and a focus on applying the rules to the substance of a transaction rather than just the legal form, and also transparency. Now, all of this needs to be applied to organisations set up with all sorts of structures, be they partnerships, limited liability partnerships, companies, sole traders, and so on. So the impact on tax matters on commercial decisions continues, and it expands way beyond just the overall tax take that's being lost by a business to the tax authorities. But it also covers things like compliance, making sure that the time spent on ensuring compliance is minimised, and also focusing on your name not necessarily being in the press for the wrong reasons. So let's look at the agenda for the day, or for this morning. So we're covering transfer pricing and the country-by-country reporting, both of which Duncan will pick up on. And we'll also focus on permanent establishments and interest deductibility, which will be covered by Malcolm. And then we'll move to the general observations and Q&A at the end. Over to you, Duncan.
Thanks, Anna. So when we spoke about this last year, it was focused mainly on the theory of BEPS. And 2016 has started to show us what this will mean for the transfer pricing world in practice. And as Anna said, it boils down essentially to two things: economic substance and transparency. The OECD want to focus on ensuring that businesses match their local income and profit in a territory to what they really do there, their economic substance and the value that they add. And in itself, this is nothing new, but the OECD are now being much, much clearer about what is expected from businesses, and this has created effectively a higher standard which is being taken up by tax authorities. So the first thing the OECD set out is to look at a business's value chain, and this initially conjures up ideas of larger manufacturing businesses, traditional corporates, but can apply just as much to the business development, contracting, delivery, and follow-up that we get in the service sector as well. It applies to all of us, and we will all have our key value drivers as we deliver these services to our clients. And that will also drill down into some of the harder to value areas, and this is what the OECD are looking to tease out. Things like intellectual property and the entrepreneurial driving forces of the business that aren't simply a straightforward transaction to be benchmarked. And that has led the OECD to another avenue, which is to look at their methods and say which are most appropriate to the types of activity that we're looking at. And that has drawn out profit split in particular as an area which has seen a lot more interest, a lot more detail and rigour to what is proposed for the new set of guidelines, and a much closer link to the value chain and risk analysis of a business that's expected as part of the transfer pricing work. So historically, the expectation was that tax authorities would look mainly at the legal structure and arrangements of a business, its intercompany agreements that govern the transactions involved. And that's still the starting point today. But the focus on substance has led to an extension of that thought to say, well, okay, if we start with this legal structure, does that match what's happening on the ground? And where that economic substance differs, that will take precedence. And that will form the basis for tax authority conclusions on what constitutes an arm's length transfer pricing policy. But also, as we develop it, what triggers a permanent establishment and questions around other tax aspects such as residence, treaty benefit or nexus. Now, today we're going to look most closely at transfer pricing and permanent establishment, but it's worth bearing in mind that to a different degree, economic substance has an effect on all of these areas, and it's now crucial to make sure that that is aligned with the tax and transfer pricing policy applied throughout the business. And what we've seen recently is this isn't just an academic risk, it is live and it is impacting businesses. And there's the traditional side of this, which comes from tax authorities, challenges around tax inquiries, the result of potential double taxation or adjustments, and the interest and penalties that go with them. But it's coming from other angles too. So we're seeing auditors pay an awful lot more attention to the existence and the robustness of transfer pricing policies and documentation. And as Anna mentioned, stakeholders, the public, customers, clients and the media are taking a closer attention too. The downside of this risk is again the traditional uncertainty over tax charges, cash flow and year-end conclusions around payments that could be made out of the business, which would be awkward and potentially problematic to revisit later on. But there is the wider dimension around audit and also the public-facing side of a business and how it's perceived in the market and the public at large. So it's important that businesses take the initiative, and this is what we are seeing happening a lot throughout 2016 and as we go into the new year. Steps are being taken to really understand where the risk areas are in a business coming from this, understanding that substance and where it might have moved beyond the existing tax and transfer pricing policy. Once that's been understood, that risk can be communicated to stakeholders to avoid any nasty surprises, and steps can be taken to remedy that and put an up-to-date, effective, supported model in place. It's probably worth pausing at this point just to think in a bit more detail about what we mean by economic substance. It's one of those things that is often bandied about, but how do you nail it down? What do we mean in practice? What we look at is an extension of the function analysis that we do for transfer pricing. Say, what are the key commercial attributes of the business? Who performs them? In particular, what are the risks and who manages those risks? And where does this all take place? In a nutshell, who does what to whom? How much this is significant and how much substance will impact the local income and profit will depend on the facts and circumstances of the business, and it will also depend on which tax issue you're looking at. So the answer for residents may be different to the answer for transfer pricing purposes, and it will depend on the business model and the key value drivers as to what cash tax impact that has. So it's important to be linked in with the business and who is making the key decisions around each of those aspects. And there's a fairly straightforward process that you can go through just to get a headline idea of this. Understanding the value chain, how do we get our key values deliverables across to clients? Then, what are the key differentiators in the market? What makes us different, and how do we manage that? How do we protect it? How do we develop it? That then leads us on to looking at the nuts and bolts of delivery, the functions, assets and risks that you would see in a typical transfer pricing study. And finally, as part of that, where do the management roles fit? Who is responsible, who is accountable for getting these things right, and which parts of the business have the financial capability to bear any risk that might go with them? Putting all of that together will give a clear idea of where a tax authority would see the value in the business, and then that can be mapped against the expectations of the current tax and transfer pricing policy, and any bridge can then be crossed to make sure the two come together.
Duncan, what types of challenges have we been seeing from the tax authorities? What are they seeing? How are they picking up these points?
That started to come through in 2016, and it's covered a variety of areas. One we've seen the most of with respect to professional practices is around management services, and that might seem to begin with to be quite basic. Often these are support services charged at cost plus a markup, but it's not so much a challenge around the markup we've seen as the underlying rationale for what those services are and the benefit they are providing. Tax authorities, in particular around, say, Italy and Spain, have been particularly strong on saying, what are these services and what benefit have these created for the local firm? Why are they willing to pay, and why are they willing to pay this amount for them? It, in a nutshell, is what are the Romans doing for us? How can you demonstrate that? And from the centre, sometimes it's obvious, and sometimes you think, well, of course we are providing our finance team, our HR team, our support and our know-how, but often you have the conversation locally and there can be that feeling that, well, yeah, we could manage, we could muddle through, and you need to make sure that a consistent, clear message comes through to tax authorities. Otherwise, you get cloudiness, you get willingness, and you get the chance for them to really come at the issue. Another interesting one that's come through from some of the tax authorities that are further down the road with BEPS is around brand intellectual property, trademarks, and their value, and how territories such as the UK or the US are charging for that. And for professional practices, that raises quite an interesting question. Are you developing markets locally, particularly where you've gone into a market for the first time because of the global multinational brand that you've developed centrally over time, or are you leveraging local partner reputations, local partner marketing activities? And if it's the former, yes, you should be charging a royalty. You should be realising that value because you wouldn't just give that away to a third party. But if it's the latter and it's really local development, local growth that you're tying into your business, then you wouldn't look to make either a charge at all or such a big charge, but that would need then to be supported to, say, the UK or US tax authorities who are likely to raise the question. So there's a real sort of fit to the facts and circumstances of the business, but also that need to make sure the documentation is right. One other that it's worth pulling out here, I think, is also around client-facing time. Again, this has traditionally been quite a nice, easy question to answer because you have third-party charge-out rates, and where you work between offices, then they form a good basis of your charging model. But often you find that those can be discounted or changed to reflect volumes or just the way it's easiest to do business. The more more those drift away from those third-party rates, the more you have to explain it, the less robust it is. And again, tax authorities have started just to drill down into the rationale between the headline number and what we're seeing charged in practice, which, if it hasn't been reviewed for some time, can require some thought in just how that is best defended.
Yeah, and given there's so much going on in businesses and quite a lot of entrepreneurial behaviour, how best is it? What's the best way to stay ahead of the challenges so that you're getting the answers before the questions are raised?
And that's the key thing, because quite often, if you go back to a blank piece of paper with transfer pricing, it can be quite a large exercise to go end to end. And what we suggest, and what we've seen a lot of businesses doing, is just break it down into manageable chunks. The key to all of this at the moment, I think, is that policy review. Make sure that whatever you're doing, you're starting from the right point, and you've got that good match to the business model. Once you've done that, it might give you the all clear, and you can report back to the stakeholders with confidence that you are happy with where things are. But it also means you can pick up just the areas that you need to address, or those which are highest risk because of the territory or the tax at stake, and put those right first. That gives you a chance to get local buy-in as well. So again, if a question comes up locally, if you have the Spanish tax authorities asking, what are these management services for, you know that you can have confidence in their reply too, and that the implementation will be right and effective. Once you've got all that in place, then documentation should be comparatively straightforward, but you'll get the most value out of it because you'll know that you're documenting the right, robust answer.
Yeah, and I guess the documentation is always there to refer back to compare whether or not that there have been changes.
So once you've got that in place, again, as you roll bits of it forward, it's not a complete reinvention of the wheel. It's care and maintenance, and that is much easier to address.
Yeah, and so the documentation is key to get the message across both internally and to tax authorities if the documentation is requested. But what does this involve? How do you best go about it?
So the OECD has been looking at documentation because they know that businesses see that this can be a bit of an administrative burden. There can be a lot of it to produce, and quite often there's a time where it sits on the shelf before it gets requested by tax authorities. On the other hand, the OECD know that tax authorities want this to be something useful and valuable to them when they get to look at it. So the OECD's approach now has been revised so that there are 3 tiers to the documentation. There's a master file, which will contain the standard information that's common to the group, so the business background, the industry, an overview of the key transactions and the key value drivers like intellectual property. So that would be a good place to have your discussion about the value of the trademark and brand IP, for example. You would then have a local file for each territory, and there might be a lot of common information between, say, Italy, Germany, Spain, which again you can replicate across those, but you would focus that on particularly the business model for each territory, so you're talking directly to that territory's tax authority. There's also a third tier for the largest businesses, which has been introduced, which is a country-by-country report, and we'll maybe have a look at that in just a couple of minutes. And I think it's important to remember that this applies to partnerships as well, and the expectation amongst tax authorities is very much that, yes, they will be reviewed together with corporates. In terms of dealing with that in a practical way, because I think that was the key bit of your question, wasn't it? It was, how do we do this? Again, you can break it down just into those manageable steps. And we suggest, again, start with that policy review. That's a good thing to do centrally. Get consistency. Make sure that you've got the right level of confidence in it. Then you can look back to what you've got documented previously, pull out and update the key things for your master file, and what we suggest is generally do one local file to begin with. Get a template set up that's going to be generally common to the offices you have globally. You can then roll that out, populate it for the local territories, and make sure you can then get local review and buy-in. And generally where we get involved is more at the top of that pile in terms of getting the policy straight, making sure that the support, the benchmarking is all there. It often makes sense for the business to tackle that local population directly. You know more about your business than we do, and are much better placed to pick up those local nuances, which is now what we need to bring out, rather than having one big group document which can be hammered onto each local territory. But when it comes to local review, local knowledge is really critical to getting these right. So again, we've got the global network and can provide support where we need to.
Yeah, and it really gives the tax team an opportunity to get stuck into the business and to talk to business-facing people rather than, you know, the other tax people or other finance people.
That's right, and also that links into the wider tax profile as well, because transfer pricing isn't a nice exercise in isolation. It will link into how permanent establishments are treated, withholding tax questions, all of that sort of thing.
And you mentioned the third slide of documentation, which I think brings us quite well on to country-by-country reporting. So who's going to be affected by that?
So country-by-country reporting has been built for a while now and is starting to come in. It's aimed at the biggest groups. It's aimed at businesses with a global turnover of at least 750 million euros in the period, which puts it at the top end, and that's really what it's aimed at, as a tool for tax authorities to risk assess the biggest businesses. But it's worth watching because, again, that 750 million euro turnover, its threshold has changed over the year as foreign exchange has moved. The UK's brought it in as one of the early adopters, alongside countries like Australia. So for the UK, filing requirements start for periods beginning on or after the 1st of January 2016, and the filing date for that will be 12 months after the year end. So there's a little bit of time, but we're starting to run out of that first period where you've got a chance to make sure that what you're documenting is going to be robust. There's some interesting questions around timing, because the idea is you do one country-by-country report for the group, but the UK has brought it in before the US, for example. So if you're looking at territories that consolidate into the UK, yet your ultimate head office is in the States, you may want to just do the exercise for that UK slice of the group. But doing that will often mean running the same sorts of processes that you would do to do the whole group anyway. And there's a question, do you want to just do the whole group, provide that to the US, who will accept early filings, where other tax authorities will need to get at the information, or do you just limit it to the bare minimum of information that you're required statutorily to provide? So there's a decision to be made there.
So it also covers partnerships, so we're again talking about a range of structures here.
It does, and there are some things that partnerships will need to consider specifically around their level of disclosure. So I suspect people have by now seen the standard forms that the OECD has put together, and for each territory you will need to complete the metrics for all standard things like revenues, profit, taxes paid, capital earnings, and a number of employees. One of the areas for partnerships to think about is that income tax paid column, because where you have corporate parts of the group, yep, they will pay tax as a corporate entity, as you would expect. But at the partnership level, then a lot of the tax will fall on the individuals who wouldn't be reported here and will have their own sets of circumstances anyway. So you might find that you have jurisdictions where you have a large number of employees, but the headline amount of tax paid is actually quite low. And as a risk assessment tool, you need to think, well, we know this is the right answer, but what message is that sending? And who will be looking at this? Are there territories that we report in which will be publishing this more widely? And this has been discussed about making this more widely available. So that is something to consider. And just to flick forward to the third sheet of the template of country-by-country reporting, which is kind of the page that is intentionally left blank to complete any further information. That is a good point and opportunity to just identify and address any of these issues if you think it's beneficial to the group, and will head off any further questions from tax authorities. I think to the extent you can answer questions on this sheet, it's a great thing to do. If all you're doing is referencing or leading through to other documents that a tax authority can inquire into anyway, it's perhaps worth a bit more thought. You might want to show that it's been addressed, but again, the idea of this is to give comfort and answer questions rather than just start the ball rolling to what would have happened anyway had the report not been put in at all. So again, there are some policy decisions that it's worth making up front.
So for businesses that are caught by these requirements, and I understand that they are at the larger end, what are people generally doing in this area? What comfort can people take from others?
So I think what we've seen is a lot of initial thinking around country-by-country reporting, but as we've got closer to the end of that first period that needs to be reported, there has been a lot of interest in running the numbers just to make sure that, first and foremost, the financial systems can deliver what you need them to tell us. And that sometimes is easier said than done. You want to make sure that what you think is the results of your transfer pricing policy is actually coming out in practice, and there's no nasty surprises, and that your implementation is matching what you've got on paper for the policy. There's been quite a close eye kept on the thresholds and the effect of foreign exchange on those thresholds, and that looks set to continue until things settle down a bit in that area. As I mentioned, there's that question about what are you filing where to meet both the requirements but also what's a practical, sensible level of disclosure. And just taking that next step to think, okay, well, we've put our information together. What does that tell the tax authority? If we put our tax inspector's hat on, do we look at this and feel that it addresses questions, gives comfort, and encourages them to, if nothing else, move on to someone else? I think if you can get to that point, then that's a sign that everything is looking pretty good and that you're happy with where you are. Any questions that come up, it's best to anticipate them and just pick those off before it becomes a tax authority-based discussion. And I think that will really shape how you treat that third table and that third part of the report, because that will pick up, hopefully, those questions that you feel need to be addressed in a bit more detail.
So it's really important to give you time to actually stand back and reflect and think, well, what does this picture actually show, rather than being really granular about the information.
Yes, you can really easily get lost in each individual number, particularly where you've got a transactional transfer pricing policy that isn't just targeting a return. I think if you can keep the holistic view, that's the place to be at this stage. But also do it before the period ends, because while the period is open, you can affect what the policies are to a certain extent. The moment that's shut, then you're stuck with reporting what you've got.
Yeah, okay. Okay, so the country-by-country reporting affects larger end of the businesses. Transfer pricing affects all sorts of businesses, whether they're in the UK TP or whether it's overseas TP, that affects them. So let's move on to permanent establishments, which also affects any sort of size of business. And we looked last year at this area, but obviously we're getting more and more information on this. So how have we moved on from the position previously, Malcolm?
Yeah, thanks, Anna. So there have been quite a few developments over the last 12 months in the area of permanent establishments, and on this slide here we've listed out the main areas where there have been some changes. An important aspect of the rules on permanent establishments is the mechanism for changing them, and we've had some developments, in fact, in the last week on that. So I'll cover off the implementation issues of these permanent establishment changes right at the end of this session. But before I go into the detail of what the changes have been, it's maybe just worth taking a step back and reminding ourselves of what the permanent establishment rules are all about. And really these rules are there to let taxpayers and tax authorities determine when a company or a partnership that's operating in a foreign territory has sufficient activity or sufficient presence in that foreign territory that it's required to register for taxes and pay taxes on the profits arising there. And companies and partnerships are allowed to have a certain amount of activity without crossing that threshold. But once they do cross the threshold, then it triggers all sorts of reporting and tax-paying obligations. And the rules that determine when that threshold is crossed, first of all, are contained in the domestic legislation of each country. So the UK, for example, has its own domestic rules around when that threshold is crossed for foreign companies trading in the UK. But then they're usually subject to treaty override. So the UK has treaties with in the region of 140 different countries, and those treaties generally contain provisions which determine for trade between the two countries that are party to the treaty when the threshold or where the threshold is set. Now, the main two areas that these treaties focus on, and these treaties are generally very similar, they're based on the OECD model treaty typically, but the areas that they focus on are what's known as the agency PE, where you've got someone potentially concluding contracts in that territory, or the fixed place of business PE, where you've got sufficient physical presence in the country to trigger the permanent establishment. The OECD and the G20, when they established the BEPS program, were concerned about permanent establishment rules because it was felt that there were a lot of companies and businesses were operating in a way that they were really pushing the boundaries, I think, here and trying to get to a point where they could have significant activity, significant presence, but without crossing the threshold. And it was felt, particularly the businesses in the digital economy, were pushing this too far. And there were a number of examples cited by the G20 and the OECD that were very high profile in the press, where there was very substantial activity in a country, typically around the business development side of things, so generating new leads and actually getting very close to signing up new customers, but not actually signing the contract in that territory. And it was felt that was really pushing it too far, that the rules needed to be changed. So they proposed changing the rules in Action 7 of the OECD's BEPS action plan. But rather than just focus on digital economy, they changed the rules across the board. Now, just thinking about the mechanism that is required to put these in place, I said that whilst there are domestic rules, the main provisions that we tend to be concerned about when we're looking at permanent establishments are the provisions in the treaties, because they override the domestic rules where a treaty exists. And each treaty that exists around the world is just between two different countries. You mentioned the UK has got around 140 of these treaties. So in order to change the rules, in theory, we would need to change each of those tax treaties. And changing a tax treaty is a very long and drawn-out process. It can take many years for the two sides to negotiate the treaty and then get that ratified. So the OECD were very conscious that they needed to do something that speeded up that process. Otherwise, it would take decades to change all the treaties around the world for the new rules on permanent establishment. So part of the BEPS process was to come up with something they described as a multilateral instrument, which had the facility for changing all of those treaties in one go for the countries that signed up to the multilateral instrument. And that's where we've had some recent developments on the multilateral instrument just in the last week. I'll cover those off just at the end, just to give you an update as to where we are on the implementation of these changes. But just looking at the areas that have been changed, it's really, as we've been talking about in the session so far, we've really been focusing on the question of substance. We're really wanting to look at what level of substance have we got in a foreign territory before we have triggered that permanent establishment and have to register for taxes and potentially pay taxes in that territory. And the focus there on the substance is around the agency PE risk, where we've been looking at the level of activities leading up to the conclusion of a contract. But there have been other changes. There are changes in some of the exemptions. There's a number of specific exemptions in the treaties around what are known as preparatory or auxiliary activities, and the exemptions there have been changed, amended. There's also been concern around fragmentation of businesses, where businesses have deliberately split up their activities into separate companies, just so that they can fall within the specific exemptions. So specific rules now coming in around anti-fragmentation. And there are very specific rules around permanent establishment, construction contracts, which had their own set of rules in the treaty. But as I said, primarily we're looking at the age and CPE, and perhaps just worth reading out and comparing the old test and the new test in these rules. So the old test looked at companies or individuals other than agents of independent status, and we'll have a look at that in a second, acting on behalf of an enterprise that has and habitually exercises in a contracting state an authority to conclude contracts in the name of the enterprise. If we had that under the old rules, then we'd be deemed to have a permanent establishment. And what a lot of taxpayers were doing was doing a lot of activity in the territory, but falling short of actually concluding the contract in that territory, and arguing that by not concluding the contract in that territory, they were not creating a permanent establishment. And probably the most famous case of this that was discussed a lot in the press was the case of Google in the UK, that had a lot of people in the UK that were carrying out marketing activities but not signing contracts with the UK customers. The contracts were signed by the Irish company, the Irish principal company in the group structure, and the argument there was that with the contracts being signed by the Irish company, then the profits associated with those contracts were attributable to the Irish company and therefore not taxed in the UK. So the new rules in the Action 7 proposals deal with that by saying that you will still create a permanent establishment in the UK or wherever if you have someone who is habitually playing the principal role leading to the conclusion of the contract. So it's quite different wording, slightly vague wording, and there's been a lot of concern over this wording, because in reality, how do you determine who has played the principal role? And it's worth thinking about that perhaps now just in the context of a professional practice organisation. If, for example, you have a partnership with a UK partner who goes overseas to build up a business in the overseas territory, but maintains some relationships with some of his UK clients and is still talking to and discussing new projects with those clients, new contracts with them while he's in the overseas territory, then I think if you were to look at that, there is an argument that the partner based now in the overseas territory is playing a principal role leading to the conclusion of the contracts that are being signed back in the UK, and therefore there is a risk that that partner has created a permanent establishment in the overseas territory in relation to that element of the trade, which I think ordinarily would be regarded as the UK trade. So I think there's some important things to think about for professional service firms in the context of these new rules. And I think, as we were talking about, it all really comes down to the substance of what is taking place in the business. There's changes as well to the get out for agents of independent status. Sometimes that was being used as a way of avoiding having a permanent establishment. Those rules have now been tightened. So if you have agents that are almost exclusively or exclusively acting for one company, then they cannot be considered to be independent. So I think a few changes, and really the message here is that groups that are operating overseas, that are expanding overseas, they really need to keep a very close eye on when they are crossing that threshold for creating a permanent establishment. And the issue that we often see with groups expanding overseas is that they don't keep a close enough eye on this threshold, and given the threshold is changing, then it is something that's going to require careful attention. And if you don't keep a close enough eye on this, then the risk is that you inadvertently trigger the permanent establishment, but only realise several years after the event. And not only have you got the issue of the fact that you didn't register, you've potentially got penalties for lack of registration, but you've also got to work out what the profits are that are attributable to that permanent establishment. And you've got to pay the tax, and potentially there's interest and penalties on the taxes that need to be paid. So it can come as a bit of a nasty surprise and can cause a lot of administrative headaches if you cross the threshold for permanent establishment, but you haven't realised it.
that, Malcolm, is something we come across really very, very regularly.
Yes.
The headache, as you say, to actually unravel it is substantial, given a lot of overseas territories are actually not necessarily clear about how you go about looking back a number of years as well. So the real practical aspects of it can get really challenging.
Indeed, and quite often it's the complexity is more around the administrative headache rather than the actual tax at stake. But it can be problematic as if you've got a tax system in the home country where you've got a credit for taxes suffered overseas, then if you'd known about the taxes that you're paying there in the right time, then you could have been able to get a credit for them. Yeah. But if you've left it several years and you're paying back taxes, then getting relief for those taxes, that credit that's paid overseas, can be a lot more problematic. And if you then start adding up the interest and the penalties, etc., then it's a very unwelcome surprise that can come across to a lot of people.
Yeah, it covers VAT as well, so it's not just direct taxes. Start thinking about the other taxes that you actually should be dealing with as well. But
exactly. I think one of the messiest areas for all businesses, but particularly for professional practice firms, is just that expansion into a new territory and keeping a tight control, keeping tabs on what is actually going on. And it's key for businesses to understand in practice what's happening, where are contracts being negotiated, where are they being signed. And I think in the past there has been this slightly simplistic approach of if we're not signing contracts, then we're probably okay. That is likely to change. So just a quick look at some of the other rules. New rules on anti-fragmentation. I think if you look at perhaps some of the online retailers that have had significant storage in the UK but have been contracting outside the UK, then in the past that might have escaped the creation of a permanent establishment in the UK or in other territories. So there are specific rules that change the scenario there, perhaps not that relevant to professional service firms, but something to be aware of, and designed just to stop people making use of the preparatory and auxiliary exemptions to get away without creating a permanent establishment in the territory.
I guess what we're saying is we really recommend reviewing activities on a regular basis, and where you've got either following a client into a new jurisdiction or it's a person within the business that wants to go to a new jurisdiction because that's what their focus is, that's really what you're recommending.
Yeah, keeping tabs on what your people are doing, and particularly now, given the ease of expansion overseas, it's very easy for people to jump on a plane. People are used to dealing internationally with people. There's all sorts of mechanisms for facilitating overseas expansion, but just keep, if you're in the tax department and the finance department of a large organisation, or even just a medium-sized organisation that's expanding overseas, then just keeping tabs on what's actually happening is the key thing. I mentioned at the beginning of this session that I'd just talk about the implementation issues of these changes to the permanent establishment rules, and I said it's all really enshrined, or the main rules that we're concerned about are enshrined in the treaties, and that to change the treaties individually would be a very drawn-out process. And therefore, the OECD announced that they would introduce a multilateral instruments approach whereby countries would sign up to changing all their treaties in one go. This is something that's been negotiated throughout the course of 2016, and we had an announcement last Thursday that that instrument has now been signed by over 100 countries. And it's interesting just to think about the way that works and to look at the impact that will have on the introduction of these new permanent establishment rules. So the way that multilateral instrument works is there is a standard instrument which looks a little bit like a double tax treaty, which has got a number of articles in it, around 20 articles in it, which pick up on all the areas of the BEPS action plan that require changes to the treaties. And those changes are, in some cases, mandatory changes for all those countries that are signed up to the BEPS action plan. But in many instances, they are just best practice changes rather than mandatory changes. And interestingly, the changes to the definition of a permanent establishment are not mandatory. They are best practice changes. Now, the way it works with any country that signs up to the multilateral instrument is that they can then choose, when they sign up to the multilateral instrument, which of the provisions of the multilateral instrument they are agreeing to. So the UK, for example, may choose to adopt the changes to the definition of a permanent establishment, or it may choose to ignore the changes to the definition of a permanent establishment. We then need to look at all the other countries that have signed a treaty with the UK and see, first of all, if they have signed up to the multilateral instrument, and secondly, which provisions within the multilateral instrument they have signed up to. And it's only if both countries have signed up to the multilateral instrument and agreed to the same provisions in the multilateral instrument that the treaties or the articles in the treaties are deemed to be changed. So we need, first of all, to see whether or not the UK signs up to the permanent establishment changes, and secondly, we then need to look at whichever other country we're dealing with to see if that has also signed up to the permanent establishment changes in the multilateral instrument. If both have, then we'll have the new rules with immediate effect, but if one or the other hasn't signed up to those changes, then the permanent establishment new rules can be ignored and we're back to the old rules. So that's going to be, I think, quite a confusing situation for a while as we try and work out whether, when we go into new territory, we are dealing with the new rules on permanent establishments, or whether we're still under the old rules on the treaty. So I think for taxpayers, it's going to be a slightly confusing picture for a while, which does require some pretty careful consideration of the activities that are being carried on.
Okay. So we'll move on to the interest deduction points, and a lot of professional service firms won't have huge issues with this. So perhaps if we can move forward through it fairly swiftly. If there's any questions, if anybody wants to actually pick up with us after the webinar, then we'll be very happy to do that.
Thanks, Anna. Yeah, so changes to interest deductions. This is, again, something that the OECD and the BEPS initiative was quite keen on, because generally multinationals, as they operate around the world, were felt to be using interest deductions excessively to erode the tax base. And the particular concern here was just when groups were leveraging up internally, so where they had internal debt from one country to another country, but between companies in the same group, and that debt was excessive compared to the level of external debt that the group had. So the recommendation from the OECD on this was that countries should introduce into their domestic legislation some specific rules that limit the amount of interest deduction. The UK in the past has been quite generous in the amount of interest deduction that we would allow. There are a number of rules that restrict it, but it was essentially based on transfer pricing around the amount of borrowing that a third-party lender would make to a UK company. Plus, there were some specific rules around anti-hybrids, the rules around worldwide debt cap, which was some slightly odd rules the UK had, and there were rules around unallowable purpose. The UK has decided to go along with the new rules. It's introducing the new rules with effect from April of next year. We'll just have a look at those new rules on the next slide. The new rules apply to UK groups, and they replace the worldwide debt cap rules, I guess, which is one thing we're quite relieved about. The worldwide debt cap rules are quite complex things to apply and work out. They apply, however, after the existing transfer pricing and unallowable purpose rules. So what we aren't doing is eliminating the transfer pricing and unallowable purpose rules at the moment. So people in the past who've gone for advanced thin cap agreements, those will continue to be valid, but we do need to take into account these new interest limitation rules as well. There's a 2 million de minimis rule, so if the net interest expense is below the £2 million, then we don't need to worry about the new rules. However, if you're above that £2 million de minimis, then we're looking at the limit being the higher of 30% of tax EBITDA and the group ratio of interest to EBITDA. So for groups that are overseas parented and have high levels of external debt, then it may be possible to get higher than 30% of tax EBITDA as your interest deduction in the UK. but for many companies, the 30% limit will be the limit that they need to worry about. So I think one of the key things on this is that the rules were announced a while ago, but we haven't yet seen the final legislation. In fact, the final legislation is due out next week. The key thing I think that groups should be aware of is that they need to review that final legislation when it comes out to see if and how they will be affected. I think for UK-only businesses, then the concern is going to be shareholder death, and the 30% ratio will be the one that they need to watch out for. But for international businesses, we may need to look at senior debt, and also we need to look at the external ratio of interest to EBITDA, as well as the internal ratio of interest to EBITDA in the UK group. And as you said at the beginning there, Anna, these rules, they apply to partnerships as well as to companies. I think it's something that we need to look at the detail very closely once these rules come out next week, just to work out the impact on all businesses.
Okay, thank you very much, both of you. Duncan, do you have some pieces that you just want to wrap up with? And then we have actually had a couple of questions that we can turn to as well.
Yes, sure, no problem. So what next is often the question that comes up at this point. And I think if we were to boil it down from everything we've talked about today, I think the message is that this is something which has triggered real change in what tax authorities and other stakeholders such as auditors are expecting to see, and it's an area which it is well worth staying ahead of the curve on. And the best way to do that is break it down into practical chunks, review the potential risk, and make sure that you know what the outcomes will be while there's still time to influence what those are. So we have put together a framework which we call E-STAR, which looks at the substance in a business and how that maps to tax and transfer pricing policy, with a view to identifying those gaps and how they might best be addressed. That's designed both to help tease out the risks so that those can be communicated, but also designing next steps to be able to address those. If you fall within country-by-country reporting, we do suggest you do a dry run just to make sure that everything works as planned, and again, you can pull out anything that needs to be addressed from that. And when the new legislation is out on the new interest deductibility rules, again, it's just worth running through what that would mean for you, again, to avoid any nasty surprises and to take steps where you can whilst periods are still open. So we would be very happy to help through all of that. We have live experience with a number of clients. It won't just be you going through these changes. We can bring in our international network, and we do try to package that all up in a practical approach that really looks at solving the problems, not just compiling documentation for the sake of documentation. We want to get to that underlying policy and make sure that really works for you. Thank you very much to everyone who's sent in questions. It's always appreciated. We have a few here which is probably worth sharing. So the first one to come through is, if you've got commercial decisions which are changing the way the business goes, potentially impacting the business model, and suggest that they might require a change to an established transfer pricing policy, is it okay then to revisit that transfer pricing policy and make the revisions you need to? The answer very simply is yes. That's what the OECD have in mind. So partly that's just keeping on top of this, the changes to the business and the way it evolves, and it gives you the chance to make sure that everything remains robust. There's also the chance, if the change is significant enough, to potentially improve the overall position and improve the effective tax rate throughout the business. If you have a change, it's a good opportunity to see what you can do to address that change, and that might be beneficial. You'll want to think about how you explain any change, walk a tax authority through from before to after, but if you've got that commercial driver, then it's exactly what's expected, and there can be opportunities for you at the same time.
One of the questions that were asked, Duncan, was around benchmarking for support services. And often where you've got UK-headed group, that benchmarking activity would be undertaken in the UK. But is that something that you can use globally? How do you leverage that internationally?
The aim really is to get a benchmarking study to work as widely as you can, because obviously you don't want to have to recreate the same thing for different territories. It's quite hard to get tax authorities globally to accept one study. You can take these things regionally, so a UK study would work in Europe. You may well find that it works in places like South Africa as well. If you were to take a UK study to, say, Asia Pac, you might struggle. But you can certainly get regional use of these things. If it's for support services, there's an additional lever because the OECD has published its guidance on lower value-added services, and those are your traditional back-office support, so IT, HR, finance, nothing client-facing, so not marketing, for example, but where you've got those support services, the OECD say 5% is acceptable. Generally, OECD members and countries that follow them should be happy with that as a low-risk solution. You find places like India will still say, yes, we know this, but we still want to see the benchmarking, which is a question I've had this week. You can usually satisfy that, again, with a regional study. It's something to watch out for. No one wants to reinvent the wheel. So you can take these things a reasonable distance. You can take the OECD's 5% for lower value-added services a reasonable distance, but just keep an eye out for local rules.
Yeah, and I suppose it's also really worth making sure that you're really clear about what services are in those. So you talked about IT, is it really developmental IT or is it support? So it's really being clear about what activities. Malcolm, did you want to...
Yeah, I was just going to say it's worth, just going back to the question on local benchmarking, it's worth bearing in mind there are a few countries that have local rules that require local benchmarking. So it's always worth checking. So places like Greece, Ukraine, Russia, China tend to have their own rules that will insist on there being local benchmarking. So even if you're operating a regional study for a region, always worth checking to see if there's some local rules that override that.
Yeah, sure.
And that's where a discussion with the local specialists, and again, it's very helpful to have them in the network, is useful, because Greece is a good example that you pull out, Malcolm, because it's part of the EU and signed up to the EU Joint Transfer Pricing Forum, which means that it should abide by their conclusions that a regional study is acceptable. However, you find that the wheels don't turn as smoothly as they should if you rely on that. So again, there's decisions to be made around that.
Okay, great. And we're almost out of time, but finally, in terms of the benchmarking support and where it fits, if you've done a benchmarking study, does it go into the master file or the local file?
The OECD's expectation is that the local file is the best place for that. If you are interested in what the master file, local file division looks like, if you go on the OECD's website, there is quite a useful short document on their revised documentation guidelines. And they've got some brief appendices in there which just set out the headings. There's a lot more to it than that, and it's worth thinking through exactly what tells your business's story in the right way and supports it in the right way is, but it will give you the headlines of what's involved, just to give you an idea of how that might compare to what you've got in way of documentation at the moment.
Yeah, sure, but that's often something that you would guide people through as well.
Yes.
And if we're looking at where most of the activity is these days on transfer pricing, I think it's probably groups that are, or international businesses that are taking their existing transfer pricing documentation, which has been set out in a different way in the past, and converting it into that new master file, local file format. Yeah. It's a big area of activity for lots of businesses.
Okay, so plenty to be getting on with. And then we've got Brexit and also what's going on in the US as well to probably change things again at another time. Okay, well that brings us to the end of the webinar. Thank you both very much for your input and for everybody for your attention in listening and raising the questions. As I said before, we will send the recording and the slides around in the next few days, but if anyone does have any further questions or would like any support in this area, please do let one of us know and we'll be delighted to assist. Thank you very much.